There's nothing about AMP itself I find appealing. It's the price you pay for that company that I think is reasonably appealing today. It's done a lot of bad things. It's lied to its regulator. It's presided over a network of advisors with a compliance system that doesn't seem to have been fit for purpose. And in our opinion and the investment, the market's opinion, it has sold an asset for about $2 billion less than it was worth. But today you look at AMP and it's got three core businesses. It has a bank, it has a fund manager, and it has this wealth management business, which is the epicenter of all the nasties that the Hayne Royal Commission has unfolded. But if you look at it, together with some of the surplus capital that it has post the Resolution Life sale, you don't pay a lot of money for the wealth management business, which is where all of the issues lie. And so we recognize that there's potential class action settlements that will ensue. We recognize that wealth management and capital, because there's a lot of codependency between the two businesses, will experience some outflows. And we recognize that there's this buyer of last resort, which I'm sure everyone in AMP is looking at and thinking, how the hell did we agree to buy back businesses at up to 4 times revenue? But all of these things are negatives that you take into consideration. And then you look at what you pay for the businesses that are left, and it turns out that you don't pay very much for the nasty part of it, and it may end up not being particularly, or having a particularly bright future. But if you're not paying for it, you should be agnostic as to whether you invest in the company or not. The other thing is sentiment. I've never had anyone come up to me and say, geez, I think AMP is a great investment, you should go and do it. And this is where contrarian investing carries the biggest punch, because no one has ever said to us, this is a good idea, we understand why you're investing in it. And so when you're wrong, which is 40% of the time, most people say, I told you so. And so it's a particularly difficult thing to do. And so we know that if we're wrong with AMP and if it does fall into the 40% category, everyone is going to say, well, we told you so. The advisors are leaving by the dozen. There's liabilities left, right, and center. Wealth management and the contemporary platforms aren't competitive relative to their peers. What could possibly have gone right? But when we look at it today, we think actually the risks are heavily skewed towards the upside for AMP at this price. But there are some things that I think can go right for AMP, and one is it carries an extraordinarily high cost base to service a financial advisor network who aren't even on its payroll, and there doesn't seem to be any economic benefit from them doing that. So if I look forward 5 years, I think one of the things that AMP could do right is streamline this advice network, either reprice it or stop providing some of the services that it does currently provide. It takes on all of the liability of remediation but gets none of the benefit, so why not just divorce oneself from that advice network, operate a very, very good platform business for administration, a good bank, a great fund manager in certain of its asset classes like real estate and infrastructure, and be good at a few things rather than being brilliant at everything, because the latter is just not possible.